I'm going to break my presentation into kind of a part one and part two, and then we'll get to the Q&A. In part one, I'll do an overview of the Australian economy. I know we have an Australian host, an Australian audience. We have people perhaps from all over the world, but a lot of focus on Australia. We'll talk about that. I'm going to talk about the pandemic. That's something that is global. That's what a pandemic is. No one is unaffected by it. So we probably all know too much about it, but a little bit of a description of that and the impact on the economy, which is really our focus. Then I'm going to talk about what I call the global depression, and that's the title of my new book, The New Great Depression. Again, something that affects everyone as part of the economic fallout of the pandemic. I'm going to focus on the United States, not just because I'm an American, but because it's the largest economy in the world. So whatever happens in the US has ripple effects around the world, including Australia and China and Asia. So we'll drill down on that, do a forecast. Then we're going to talk about what investors can do broadly in terms of asset allocation, investments that will see them through what is obviously a very uncertain period. So that's part one. Part two, I'm going to talk about the future of money and kind of four topics that everyone has some interest in. Gold, certainly, Bitcoin. We've got some great speakers. Greg has some great speakers lined up specifically on Bitcoin, but I'm going to talk a little bit about it. Maybe say a few things that you've never heard before, a different way of looking at it, put it that way. The new kid on the block, central bank digital currencies. And then finally, our old friend SDRs, special drawing rights, SDRs, which is kind of world money from the IMF. So that's a quick overview, and then back to Greg for some questions. If I don't get to a topic, never fear, because we'll probably cover it in the questions. So let's start with Australia. I mean, what can you say? The Australian economy is very strong. They don't call Australia the lucky country for nothing. Right now, your interest rates are low. You've got an easy money policy from the Reserve Bank of Australia. You've had a smooth transition from the JobKeeper program. There was a lot of concern that when that benefit ended, that perhaps people wouldn't be able to get jobs and consumption would dry up. That has not happened. The job market is strong, and so the JobKeeper kind of did its job, has gone away, which is good from a fiscal point of view, but that was not disruptive. Australian retail sales were down a little bit in the last month, but still positive, and they're expected to grow as the vaccination program spreads. Australia got off to a little bit of a slow start, but catching up fast. So again, that's moving the country towards what epidemiologists call herd immunity, and we're not at the end of the pandemic, but certainly I would say the end is in sight, and Australia is making good progress there. A couple other points that are important to bear in mind. Australia has one of the lower debt to GDP ratios of any developed economy, meaning your national debt divided by your GDP, that's a percentage. The US is sky high. I'll talk more about the US, but Australia is in a very good position. It has a sustainable debt to GDP ratio. What that means is if you need fiscal policy help, you can get it. You have headroom to run larger deficits and expand fiscal stimulus. I'm not saying that Australia will need it. What I'm saying is if you need it, you've got the headroom and you can do it without some of the negative consequences that we are seeing in the United States. So that's another plus. Inflation's low, which means if you need monetary stimulus, you can get it. Again, if inflation's running out of control, central banks have to rein it in. They can't provide easy money forever. They can do it for short periods of time, but if inflation is on the horizon, you might have to rein in your monetary policy. Again, that's not the case in Australia. Inflation is very well behaved, and you have room for monetary stimulus if you need it. Despite the kind of de facto trade war between China and Australia, China's acting like a bully, cutting off certain imports from Australia, most famously wine. But the fact is, Australia has what China desperately needs: coal and iron ore. So, okay, maybe you're not selling as much wine to China, but coal and iron ore exports from Australia to China are running close to all-time highs. China is stimulating its economy the way they always do, which is with debt and construction. They're very good at building things, that whether they need everything they're building, whether they're wasting that debt on white elephant projects or train stations with 128 escalators that are mostly empty. Who knows? But they're doing it. That's how they drive ahead, because they don't really have a consumption-driven economy. They have to have an investment-driven economy, and if the investment's wasted, that's a problem for another day. But in the meantime, keep the steel mills going, keep the electric generators running, and they do that with coal and iron ore from Australia. So it's another strength. So on the whole, strong growth should continue. The central bankers said they're going to continue the QE for a while longer. They haven't set a deadline when they'll cut it off, so-called tapering, but at least through September, possibly later, you've got room for larger deficits, and you're going to have some tax relief. So I don't like to sound like Pollyanna. If I see problems, I'm the first one to call them out. But Australia just is kind of hitting on all cylinders right now. Strong comeback from the pandemic, strong recovery, and room to grow, room to take this further, both in terms of fiscal and monetary policy. So sort of all good on Australia. There are three vulnerabilities. Again, I don't want to suggest that nothing could go wrong, but there are three things that could go wrong that Australians need to bear in mind despite all the good news. The first one, and this is critical, is a slowdown in China, because Australia is so dependent on exports to China. If China slows down, Australia slows down. It's as simple as that. For the time being, we're coming up July 1st on the 100th anniversary of the founding of the Communist Party of China. That's a very big deal, centenary. China's determined that nothing can go wrong between now and July 1st. So nothing will be allowed to go wrong. So I would expect for the next few months, at least, everything will continue. But after July 1st, they're going to have to face up to some of these problems, including perhaps a new housing bubble, over-leveraged, bad debt, wasted investment. They don't want to do anything right now. But later this summer and certainly later this year, you might see the Chinese economy slow down. That could be a little bit of a headwind for Australia. A bigger headwind, which I'll talk more about in a minute in a lot more detail, is a U.S. slowdown. It's not so much that Australia exports a lot to the United States. There are some exports, of course, but it's kind of a triangular trade. Australia exports raw materials to China. China does the manufacturing, and the U.S. consumer buy the Chinese manufactured goods. Well, if the U.S. slows down and we buy less from China, China's going to need less from Australia. So it's a kind of a bank shot if you want to think of a billiard table. But Australia is indirectly vulnerable to a slowdown in the U.S. because if we slow down, China slows down, and then that affects Australia. So, and the third thing I would look out for are asset bubbles. Good news is good news. That's fine. But if housing gets too hot, if the stock market gets too hot, those things have a way of correcting. So, again, applaud the good economy, good fiscal monetary policy, weather the Chinese bullying in good form. So a lot going on in Australia that's very positive, but watch out for asset bubbles, particularly, and again, I'll talk more about this. If the U.S. stock market's in a bubble, which they are, and I'll be specific about that, and there's a severe correction later this year, which I expect, then that could affect Australia as well. So right now, fundamentally, all good on the Australian economy. Exports booming to China despite the bullying by China. Jobs are plentiful, housing prices are going up. You have room in fiscal monetary policy, but watch out for a Chinese slowdown later this year, a U.S. slowdown later this year, and maybe some severe corrections in our stock market that could have a ripple effect in Australia. Let me switch now to the pandemic. Of course, that's the biggest story in the world for the last 2 years. Things are definitely improving. It's not over, but it's getting much better. Caseloads and certainly fatalities are dropping precipitously in the U.S. and Australia. This fourth wave, which we saw in the U.S., is abating very quickly. There is a world, the world numbers are sort of three waves: an initial wave last spring, a strong wave last winter, and then a new wave right now, which is the worst of the three, primarily driven by caseloads in Brazil and India. But that is tailing off. Interestingly, when I wrote my book, The New Great Depression, it was kind of half economics, half the pandemic, epidemiology, and virology. And so I did a deep dive on the science here. And one of the most interesting things I discovered is that these waves take about 8 to 10 weeks. They're very predictable. Hard to predict exactly when and where they're going to break out, but when they do, you can predict a downslope after about 8 weeks, and that seems to be playing out. That's something that the virologists don't talk about because it's math and statistics, but the applied mathematicians have sorted it out from data, and so even on that basis, we're seeing a lot more good news despite some of the problems in India and Brazil. Vaccine rollout is irregular around the world. Australia was a little bit slow. Some countries, the UAE, actually, Israel, and some others have done a great job. The US has done a pretty good job. Europe, not so much. It's uneven, but it is happening. And even the people who got off to a slow start are catching up. Herd immunity is gaining. Herd immunity comes not just from vaccinations, but also from survivors. If you had COVID and you survived, you've got better antibodies than people getting the vaccines. So the combination of the two, the survivors and those who are vaccinated, give the virus fewer places to go. Viruses hop around from host to host, which in this case is human to human. But if every time the virus hops, it encounters someone who has the antibodies either from having had it already or from the vaccine, then eventually the virus dies out. That's how these things fade. And that is happening. There is, again, you got to be very alert to what's called mutational escape, where the virus mutates in such a way that it evades the impact of the new vaccines. That is not the case so far. Let's hope that continues to be true, but another thing to keep an eye on. Most of the economic damage is really from bad public policy. Lockdowns don't work. I know you had a severe lockdown in Victoria. A lot of people applaud that, but the fact is there have been studies from using the United States as an example. There was never a national lockdown in the United States. We had 50 states. So we had 50 state lockdowns imposed by governors and mayors of varying degrees. California and New York were extreme, probably a lot like Victoria. Melbourne, Florida was moderate. Some states like South Dakota never had a lockdown. It was completely voluntary. Just kind of use common sense. Same thing around the world. Italy, France, and Spain, among others, had extreme lockdowns. Sweden had a moderate lockdown. Other countries, Brazil, at least initially, did very little. But at this point, a year on, we've been able to get the data. So you can do scientific studies. You don't have to guess or you don't have to politicize it. And the studies show clearly there's no correlation between lockdowns and caseloads. No correlation between the type of lockdown you had and how quickly the virus spreads. In other words, lockdowns don't work. Politicians do them anyway because they have to be seen to be doing something, but they don't seem to be reading much science as far as that's concerned. So the economic damage in Australia and around the world was done by the lockdowns, but lockdowns didn't really do any good. But the good news is the virus is fading on its own. Some things make sense. Hand washing obviously is a plus. So we're seeing the pandemic fade. It's fading faster in Australia and the United States, more slowly in Japan and some other countries, and still a serious problem in Brazil and India. So we're not out of the woods yet, but things are getting much better. So it will have less of an economic impact going forward, although I would drop a footnote there and say that what we're dealing with now is the aftermath of the mental health problems, the adjustments people are having. Governments made people live in fear for a year and everyone was wearing masks. Now that, there's 0 cases have been discovered of viral spread outdoors. This thing just doesn't spread outdoors, but there's no reason to wear a mask outdoors. But people do it anyway because they adapted to the mask and now they can't take it off. So we're seeing the residual fear, which is a continued headwind for growth. So you can put it in the mental health category rather than the epidemiological category, but it's real. And again, that's going to slow growth around the world relative to what it would be otherwise. With that kind of as a backdrop, again, news is getting better, not quite out of the woods, but it'll be less of a factor going forward. But don't underestimate the adaptive behavior that has occurred and that will continue to slow growth. Let me pivot now to what I call the new Great Depression or the Global Depression. Here, there's a lot of confusion over definitions. People are familiar with the definition of a recession, the R word, recession. It's generally defined as two or more consecutive quarters of declining GDP. A couple other bells and whistles, but that's basically the definition. Australia got through their first recession in, I think, 26 years, maybe 27 years, but I think the longest on record for a developed economy. The US got through a severe recession in 2008, 2009, and had another, the most severe since the end of World War II in 2020. But that's over. There is growth. Growth rates vary, but there is growth around the world. At least in the United States, North America, generally Australia and China. Europe is in a back-to-back recession. They had a recession in early 2020, a recovery in late 2020, and a new recession now. So Australia's back in recession. So that's the definition of a recession. So people have an intuition that, depression sounds worse than recession. So if a recession is 2 quarters of declining GDP, 2 or more, a depression must be 10 quarters of declining GDP. It must be some really horrible thing. And depressions are bad, but that's not the definition of a depression. You can have growth in a depression. It's just that the growth is below trend. It's below potential. And so it's depressed growth. This is true in the United States during the first Great Depression from 1929 to 1940. 1929 to 1933 was a flat out depression, down the whole 4 years. But the Great Depression is conventionally dated from 1929 to 1940. But in the middle of that, 1933 to 1936, the US had pretty good growth. The problem was it had fallen so much prior to 1932. It was growing, but it was in a very deep hole. It never got back to the pre-1929 levels. The stock markets never got back to those levels until 1954. Commercial real estate never recovered the pre-1929 level until 1954. It took 25 years to dig out of the hole. So even though you have growth in a depression, it's depressed growth relative to trend. You still haven't recovered your losses. Today, the US has not regained the 2019 levels of output. We had growth in 2020, pretty good growth in the third quarter, growth in the first quarter of 2021, but we're still not back to where we were in 2019. So that's a depression. That's going to continue for a long time. We will have growth. We do have growth, but it'll be quite low relative to long-term trends and will not get us back to where we were for a considerable period of time. So that's what we mean by a depression. And you have to look at not just lost output and growth, you have to look at lost wealth. People say, oh, look, we're having a reopening, restaurants are reopening. Well, yes, a lot of restaurants are reopening if you survive, but a lot of restaurants didn't. They're closed permanently. They broke the leases, they fired the employees, the equipment's up for sale, 10 cents on the dollar. In other words, you may get output, you may get GDP back with these gradual reopenings, but where's the compensation for the lost wealth? And that is another problem. And again, it's a major setback, and it's why we're in a depression. There is no pent-up demand. That's nonsense. You hear a lot about it. Oh, the economy will come roaring back because of pent-up demand. No. The example I give, and there are many examples, but during the 2020 quarantine, we were locked down for about 14 weeks. My wife and I like to go out to dinner on a Friday night. Well, for 14 weeks, we didn't go out to dinner. First of all, because the restaurants were closed, and secondly, because everyone was pretty much locked down in their homes. Well, by last summer, restaurants reopened. We went out to dinner, but we didn't order 14 dinners. We ordered one, the way we usually do. In other words, okay, we were back out. The restaurant was getting some revenue, and we were having dinner, but those 14 dinners we skipped were permanently lost. There's no pent-up demand for those lost dinners, think of anything else. Shopping, groceries, dinners, movies, shows, vacations. it's just lost. So there is no pent-up demand. There is no V-shaped recovery. The notion of the V was that it would go down sharply and come back sharply. Didn't happen. What happened was it went down sharply and it came back, but then it truncated. Right now we're leveling out. So we have sort of a half a V on the upside, but not a full V. We're not back to where we were. And that strong growth, relatively strong growth coming out of the bottom of the recession from 2020, which persisted pretty much through the third quarter, and then it petered out again. That is now flattening. So are we in a second technical recession? No, but we're not growing anywhere near what we need to regain the lost growth in many measures. And so we're back to kind of that weak growth, which we had from 2009 to 2019. We had 10 years of depressed growth following the global financial crisis, and we're kind of getting back to that again. So don't buy into the story of, we're in a super boom or super growth period. We're growing, yes, but it's quite weak. And so I would also emphasize, again, I talked a little bit about the mental health aspects. We don't have to call it mental health, just call it behavioral adaptation. It takes a lot to get people to change. And the pandemic is a big deal. Worst pandemic in 100 years. Third worst pandemic in 650 years, going back to the Black Death and then the Spanish flu and now the COVID-19. So people changed their behavior. They stayed home, they became fearful, they put on masks, they closed businesses, etc. Well, now everyone's saying, well, the virus is under control, vaccines are spreading, herd immunity is building up. You can't get it outside. After all, the 6-foot social distancing was a joke. After all, now they tell us, but by the way, the 6-foot distancing came from a 19th century German scientist who was working on a different pandemic and said it was a guess. There was no real science behind it. And he was candid about saying it was a guess. Somehow that became the law of the land, but there's nothing to it. These things didn't work. They didn't help, but they did destroy social interaction and destroy the economy. Well, now a lot of that is going away, but the behavior is the same. And this is my point. It's not like throwing a light switch where, we'll just be the way we were in the summer of 2019. No, these effects will be intergenerational. These effects will linger. They will not go away easily. There's always a place for anecdotal evidence. I was out shopping the other day. I was minding my own business, looking at light bulbs, and overheard a conversation with one of the customers and the clerk at the counter. And he was saying, I hear the bars are reopening, but I'm not going. If that's all you have, if that's your entertainment, fine, but I'm not going. I probably won't be in a bar for another year, and I'm wearing my mask. I don't care what anybody says. Well, those are choices. I didn't say a word, and I'm not going to, and I'm not here to tell other people what to do. Let everyone make their own decisions. But I found it fascinating as an anecdote that there was no science, no necessity behind what the guy was saying. But he was demonstrating the fact that he can't go back to the way he was. He can't suddenly spend money at the bar or a restaurant or movie theater or any place else for that matter. And that he expected he wouldn't change his behavior for a year. Well, you know what? He might not change his behavior for 5 years, for 10 years. These effects are intergenerational. The effects of the Great Depression of the 1930s did not wear off until the late 1960s. It was the baby boom when they came of age in the late 60s. Then it was, credit cards and debt and leverage and rock and roll. But behavior in the 50s, 1950s and 1960s, early 1960s, was still prudent, still low consumption, still savings driven, still demonstrating the behavior that had been learned, the adaptive behavior that had emerged during the Great Depression. So don't underestimate the extent to which these effects linger for a very long period of time. We've had this change in psychology. So this global depression, defined as below trend growth in Australia, in the United States, despite a bounce back, and Europe and elsewhere, is going to be with us for a long time. So it doesn't mean there won't be any growth. It'll be a lot less than people think. It won't support the kind of stock market valuations we're seeing. And a lot of it is behavioral. You won't be able to change it with fiscal and monetary policy. It'll take, as I say, the better part of a generation and a younger generation, maybe generation Z, I guess they call them, to really come into their own and change things again. This happened in the late 1960s. Let me pivot now to the U.S. economy in in particular, the largest economy in the world. I mentioned the lingering effects of the pandemic, behavioral adaptations, as reasons why the U.S. economy will not come back as strongly as a lot of people expect, why it will underperform. But there's a long list of additional reasons. Pardon me. One of them is the policies. Pardon me. The policies of the Biden administration. I don't want to debate the policies. There are two sides, but I will just tell you, economically, they're all bad. They want higher taxes. They're shutting down energy. They're shutting down oil and natural gas drilling on federal lands, new permits. They shut down the XL pipeline. Borders are wide open, which means wages will be held down. Again, I don't want to debate border policy. I'm just telling you right now, we don't have a border policy. The border's open. Millions are streaming in, and whatever the minimum wages, they don't care. They're here illegally. Why would they care about working for $3 an hour? They will. And that drags down wages for everybody. If you're a legal citizen and you're entitled to a minimum wage, pardon me, you still can't get the job because you're competing with the illegal who's working for half the minimum wage. So again, whatever you think of open borders, that's one of the economic consequences. So these are all slow growth policies, job killing policies. One of the curious things in the United States right now is employers can't find workers. They're reopening, the movie theaters, the bars, the restaurants, the salons, the boutique shopping, they're all reopening. They can't find anyone to hire. There are major shortages in terms of the ability to hire. At the same time, we have 10 million Americans between the ages of 25 and 54 who are who are not working, technically not unemployed because they're not looking for jobs, but they are de facto unemployed because they don't have jobs, and many millions more who are collecting unemployment benefits. And that's the problem. We increased our unemployment benefits, we extended them and raised them over $300 a week. So you can make $35,000, even $40,000 a year in unemployment benefits, child care tax credits, etc., earned income credits. And if you have a $35,000 a year job, even if you have a $45,000 a year job, would you rather sit home and do nothing and collect $40,000 in government benefits, or go back to work and maybe make $45,000 and pay more taxes and further ahead? Well, a lot of people are sensibly or not, a lot of people are choosing to sit home and collect the checks. So we had relatively high unemployment, low labor force participation, tens of millions of Americans not working who could be, and yet employers can't find workers. But that's because we're paying them to stay home. So that's another, that's going to result in higher wages, at least for a lot of employers, and slower growth in the economy. So these are all policy issues where they've got the policies wrong. There are new policies coming along later this year that are going to continue this slow growth scenario that I described. What about stimulus? What about monetary stimulus? The Federal Reserve has printed over $4 trillion of base money, and that's M0, so-called, and our M1 numbers are going up even more. People go, well, look at all those trillions of dollars the Fed is printing. We're going to get inflation. No, we're not anytime soon. Money printing does not cause inflation. The Austrian school says it does. A lot of the libertarians say it does. It doesn't. We had money printing with QE 1, 2, 3, and 4 from 2009 to 2019. We never got serious inflation, and we're not getting it now. Money printing does not cause inflation. What does cause inflation is velocity. That's the turnover of money. An example I've given before, I go out to dinner and I tip the waiter, and the waiter takes a taxi home and tips the taxi driver, and the taxi driver takes the tip money and puts gas in her car. Well, in that example, my dollar has a velocity of 3. It supported $1 supported $3 of goods and services. The waiter tip, the taxi tip, and the gasoline. But what if I stay home and watch TV? Well, now my money has velocity of 0. My money's still in the bank. I didn't spend it. And I remind people that $7 trillion times 0 is 0. That's the quantity theory of money. In other words, it doesn't matter how much money you have. If you have low velocity, you're not going to get nominal GDP. You're not going to get the growth. Just to give an example, in the fourth quarter of 2007, velocity was 10.7%. It means every dollar supported $10 of goods and services. Today, it's around 3.5%, meaning a dollar only supports $3 of goods and services. Velocity has plunged. In the first half, if you look at a chart, in the first half of 2020, it looked like an Acapulco cliff dive. It went straight down. Someone asked me the other day, how low can velocity go? And I said, well, technically it can go to zero. I don't think it will, but even if it goes from 3 to 2, that's a 1/3 decline in nominal GDP, all things equal. So the Fed has to print money just to keep the economy from collapsing, but you're not getting inflation. You're getting zero interest rates, and people say the U.S. interest rates have gone up. Recently, they're referring to the yield of maturity on the 10-year Treasury note. That's not a short-term rate. That's an intermediate-term rate, or even a long-term rate. Okay, it's 1.6%. Well, a few years ago, it was over 3%. So it has gone up from 60 basis points to 160 basis points, but it's still lower than it was during the last spike. It's a pattern of lower highs and lower lows. The trend is still down. So interest rates are dropping. Fiscal policy has no stimulative impact. And people say, well, how can that be? You had $1 trillion baseline budget deficits in fiscal 2020, fiscal 2021. Donald Trump put on $3 trillion of additional deficit spending on top of that. President Biden so far has put on $2 trillion of additional spending. So that's 5 plus 2, so that's $7 trillion of deficit. And the Biden administration is planning $4 trillion more later this year, which they're going to get probably before September. So that's $9 trillion of deficit spending. When going into this, the national debt after 230 years was only $22 trillion. So you just put $9 trillion of deficit on top of $22 trillion. It took, again, 230 years to get to 22, but we got to 31 real fast, just in 2 years. Well, doesn't that mean the economy is booming? Again, the answer is no. And the reason in the United States, this is not true in Australia, by the way, but it is true in the United States. Our debt to GDP ratio is 130%. That's one of the worst in the world. If you said, well, who else is kind of close to that? The answer is Italy, Lebanon, and Greece. There's your lunch table. Is that the group you want to be compared to? Even countries in Europe that are more more socialist than the United States, that the Americans like to make fun of in terms of fiscal irresponsibility, are better than we are. Spain is about 90%. Spain, France are well below 100%. Germany is even lower, closer to 60%. The US is 130%. And so what happens is, and the research on this is very clear, when you go past 90%, when your national debt is more than 90% of your GDP, your so-called Keynesian multiplier, fiscal multiplier, drops below 1. Now, what does that mean? Well, it means that at lower levels of debt, so again, Australia would be a good example of, you have 30 or 40% debt to GDP ratio. If the government borrows $1 and spends $1, you can get more than $1 of GDP. You can borrow $1, spend $1, and you can get $1.25 of GDP. So that's the stimulus that has some stimulative effect. Whether that's temporary or permanent or just bringing demand forward, that's a separate debate, but it does work that way. Borrow $1, spend $1, get $1.25 of GDP. But above 90%, you borrow $1, you spend $1, and you get less than $1 of GDP. You might only get 90 cents or 80 cents or even less. That's where the United States is now. But the result of that, and again, this is simple math, is if you're increasing your debt by $1, but you're only increasing your GDP by, say, 80 cents, what's happening to the debt to GDP ratio? It's going up. In other words, there's more debt being piled on top of a given amount of GDP. The ratio is going up. Well, the ratio is the problem in the first place once it's over 90%. Now you're making it worse because you're still borrowing and spending, but you're not getting the GDP to support to go along with that. Your Keynesian multiplier is less than 1, so you're just digging a deeper hole. That's why you can't borrow your way out of the debt crisis. So monetary policy in the US won't work because of velocity. Fiscal policy won't work because the debt to GDP ratio is too high, and there's a behavioral adaptation. People look at that you don't need a PhD in economics. You just say to yourself, hey, I don't know how this is going to end, but they're either going to have inflation or they're going to raise my taxes. The third way out is default. The U.S. doesn't have to default because we can print the money, at least for now. But people say there's going to be inflation or taxes. They're both bad outcomes. So people save more. It's called precautionary savings. And guess what happens? When you save, you're not spending. So that affects consumption. And that's another reason that the economy is slowing down. So the U.S. forecast, I'm not forecasting a second recession, but I do forecast a continuation of a depression, much slower growth than expected for the reasons I mentioned. Let me just kind of recap a little bit and go through some recommendations for investors. I recommend a decent sized allocation to cash, perhaps as much as 30% of your portfolio. And people go, well, wait a second, cash has no yield or practically no yield. What good is it? I want stocks, or I want things that are going up. Well, okay, but cash has a lot of hidden benefits that people underestimate. One is that, first of all, it reduces the overall volatility of your portfolio. So if you have volatile assets over here like gold or real estate and other volatile assets like stocks and bonds, a slice of cash in the middle will reduce the overall volatility, so maybe you can sleep a little better at night. People worry about inflation, fine, but I would suggest that deflation may be a real problem, at least for the next year or two. And cash can be your best performing asset in deflation because the real value of cash goes up. But most importantly, cash gives you optionality. Obviously, based on what I've said, there's a lot of uncertainty, pandemic uncertainty, policy uncertainty, economic uncertainty. If you're the one with cash, you can pivot as visibility improves. In other words, if you're all in stocks and the stock market crashes, but you've got cash, you can go shopping in the wreckage. You can be the ones who picks up the bargains. Or if some other asset class collapses, again, the person with cash can buy those. First of all, doesn't lose because cash won't lose value, doesn't gain a lot of value except in deflation, but it won't lose value. But if something else does, you can come along and shop for the bargain. So that optionality, that embedded optionality is a very valuable aspect of cash. Residential real estate should do well, it should outperform, not for good reasons, by the way. It's because people are leaving the cities. The pandemic has taken, it's left cities with all of the detriments, which are, crowds, noise, pollution, crime, etc., but none of the benefits. The culture's gone, the museums are closed, the theaters are closed, the restaurants are closed. Okay, they're starting to reopen, life is coming back a little bit, but cities have been pretty dismal places to be, and the population density is high, which there's still the residual fear of the pandemic. So people are just leaving the cities and going to the suburbs or even going to the country. And that is part of what's driving this residential real estate boom. So residential real estate is an attractive asset. Commercial real estate is not off the bottom. It's too soon to jump in, partly because of the work from home phenomena, partly because, depending on the market, social unrest. And a lot of tenants are out of business, so we can't pay the rent. So commercial real estate is something you might look at in late 2022 or early 2023. Too soon to jump in. I recommend a 10% allocation to gold, physical bullion, keep it in a safe place. It's protection against inflation, but gold actually does very well in deflation. During the Great Depression, longest sustained period of deflation in U.S. history, gold went up 75% from $20 an ounce to $35 an ounce. So people kind of get the fact that gold does well in inflation, but they are not as well acquainted with the fact that gold does well in deflation also, particularly in a period of low interest rates when gold is competing with notes for investor dollars. Low interest rates make gold relatively more attractive. High quality government notes, Australian government bonds, U.S. treasuries will continue to do well. Interest rates have not hit bottom. They're low, but they can go lower, and they will. Equities have a very strong bubble characteristics right now. Now, the problem with bubbles is they can get more bubbly. You can't just look at a bubble and short it. I don't recommend that. But you can be pretty sure the bubble will burst at some point, perhaps sooner than later, but not right away. The bubble can continue for a while. I mean, just looking at the U.S. equity markets, there's something called the CAPE ratio, invented by Nobel Prize-winning economist Robert Shiller and a collaborator. It's basically a PE ratio, price to earnings ratio, and you're all familiar with that. But Shiller does two things. Number one, he takes the 10-year average of the price to earnings ratio. And the purpose of that is PE ratios kind of go up during a boom and down during recession. And his view is take a 10-year average, and that will factor out the business cycle and give you more of a pure play on the business itself and the economy itself. And he adjusts them for inflation so you can compare the older data and the newer data. It's apples to apples. That CAPE ratio today is at the second highest level in history. The only time it was higher, the CAPE ratio basically means the price of the stock relative to the earnings. For a given amount of earnings, what multiple do you apply to get to the level of the stock market? But again, with these adjustments, they call it the CAPE ratio, cyclically adjusted price earnings. It's at the second highest level in history. The only time it was higher was before the dot-com crash, but you remember the dot-com crash? Our US NASDAQ fell over 70% in a couple of years. Right now it's higher than it was on October 1987 when the stock market fell 22% in one day. It's higher than it was on Black Tuesday in October 1929 when the stock market crashed and began the Great Depression. So I'm not saying it won't go higher. I'm not saying it's over. I am saying that that is a nosebleed level, and no one should be surprised if the stock market crashed tomorrow. If you just take a straight price earnings ratio, not the cyclically adjusted one that Shiller does, just the S&P 500 price earnings ratio, right now, again, second highest level in history, higher than immediately before the Great Depression, higher than the dot-com, 3 times the long-term mean, 3 times the long-term median, higher than during the Roaring '20s. The only time it was higher was right after the global financial crisis, right around May 2009, when prices had taken off because we were kind of coming out of a bad recession, but earnings had not caught up. At that point, it got crazy. It was over 120 to 1, but right now it's 44 to 1. And again, that's the second highest in history, other than that one very brief anomaly. Dividends are the second lowest. Dividends to stock prices are the second lowest level in history. So by every measure, historically, recently, low dividend earnings, high PE ratios, high cyclically adjusted PE ratios, and other metrics, the US stock market is in a bubble. It's very clear. But when will it burst? Well, it's hard to say, but the most likely scenario, so you have a narrative. So what's the narrative? There is no alternative to stocks. Bonds are low, gold has been kind of going sideways. Commercial real estate suffering, Europe's in recession, etc. So TINA, there is no TINA, there is no alternative. That's one narrative, a fear of missing out, FOMO, FOMO, fear of missing out. Who wants to go to a cocktail party or the club and have all your friends tell you how much money they're making in the stock market and you're not invested in stocks? So the social pressure to jump on the bandwagon is extremely high. The economic myths I busted earlier, the V-shaped recovery, not true, but people believe it. Pent-up demand, not true, but people believe it, etc. So there are these belief systems, these narratives, which are very powerful, which are driving the stock market higher. Plus the idea that you can't beat the market, which is not true, but a lot of people believe that also, leads you to passive investing, index funds, ETFs, etc. Well, what happens when money goes into an index fund? Well, they buy stocks. So what happens is the stock price goes up. So more money comes in, they buy more stocks and the price goes up. So you have a recursive function, a feedback loop of money coming in and the price is going up. And it works, but until it goes backwards, and then it drops really fast. So the way I think about it is that we have a narrative driving the stock market higher. Earnings don't support it. Fundamental economic growth does not support it. The narratives do. So when will the narratives change? And my expectation is by late this year, perhaps November, we'll have second quarter data, we'll have third quarter data. We'll begin to see that the economic reality is highly divergent from the narrative. That the narrative is not true. It's not true today, but people think it is, and that's what's important, that's what counts. But when people can no longer pretend, when the reality catches up to the narrative and the narrative changes, then stock market values will change. So you might the U.S. stocks will probably go higher, but I would say by late this year, and I'll use November as an estimate, it may be the case that the economic reality is caught up to the narrative changes and stock markets crash. Bitcoin's a Ponzi. It's not a form of money. It's a pure speculation. I prefer roulette, but if you want to buy some, knock yourself out. But it could, by the way, I wrote about this last month, and I said what I'm saying right now. This is not a view formed because Bitcoin had a bad week. It did have a bad week. It was down almost 50% from high to low over the past couple of weeks. But independent of that, I mean, Bitcoin could go back to 100,000 or higher, or it could go down to 10,000. There's no way of knowing, and that's the point, really. It's not a store of value. You can't spend it. It's not money, and it's not a unit of account. It is what it is. The real danger of Bitcoin is not that the price goes down. It's that it disrupts our linear way of thinking with regard to money in general. That Bitcoin will not replace the US dollar, but it may destroy the US dollar by destroying the concept of money, to the point where, is it a video game, or is it real, or what is money? And once you get into that world, and we're kind of in that world, we just don't realize it. It's, so the old saying, we don't know who discovered water, but we know it was not the fish, because the fish is in the water and doesn't know about water until you take it out. We're in the world of Bitcoin, and everyone's spun up about price and blockchain and all that stuff. That's all content. It doesn't really matter very much. But what does matter is the water, the electronic environment that we're in, the immersion, the water around the fish, which is destroying the idea of money, and that may have consequences that go way beyond Bitcoin. So, Greg, I'm gonna stop there. I'm gonna toss it back to you, and look forward to some questions.
Jim, look, we've got a number of questions come through, and also I've got a few questions to ask. And certainly, congratulations on your presentation. I do love how much you know about what's going on in Australia, and which is fantastic. Jim, first of all, I know you have a great passion for gold. And of course, you were saying that when we last spoke with you, and somebody has asked this question again, is that, you were saying that gold was going to reach 15,000 US. Right. And as you know, as we speak, it's about 1,888. So do you still believe that it'll go to 15,000, and how quickly?
I do believe that. I think the analysis supports that, and I'm happy to explain that. There are, and by the way, this will take several years, so the horizon for that is maybe 2025. Could be sooner, but 2025 is a reasonable estimate. And I based it on three things. Number one, there's no central bank in the world that wants a gold standard today. It's not like there's some secret cabal of central banks. Let's go back to the gold standard. That's not happening. They don't want it. But they may have no choice. It may be the case that there's a loss of confidence in command money, or so-called fiat money, paper money, whatever you want to call it. And they have to do something to restore confidence. So it's not a question of do they want it, it's a question of do they have to do it? Is it out of necessity? Well, if you do, it begs the question, well, what price would you go back to? What would the US dollar price of gold be if you were going to have a gold standard? Again, I'm not saying they want it. I'm saying they may have to go to it out of necessity because of a more general loss of confidence in central bank currencies. Well, you can make two mistakes. If you're going to have a gold standard, so the paper money is convertible into gold, et cetera, if you get the price too low, everyone's going to come buy your gold, and you'll be out of gold very quickly. It'll be a repeat of what was happening internationally in 1971. If you get the price too high, you'll have the opposite problem. Everyone will sell your gold and say, give me the money. And the first, where the price is too low, is actually inflationary. And the other one, where the price is too high, is deflationary, and they're both bad. So you have to get to the right price, the right exchange rate. It's just like any other cross exchange rate between gold and dollars, so that it's not inflationary on the one hand, not deflationary on the other. Well, how do you do that? Well, it's a pretty simple math problem. You basically take the gold supply, which in the case of the United States is about 8,100 metric tons, and then you take the money supply, which varies, but we can estimate that. By the way, you'd have to do this globally. You'd have to get, Japan and Australia and Canada and Europe and other major economies to join you to prevent arbitrage. But basically, the numbers are a global M1 is about $30 trillion. It varies, it's growing, but it's about $30 trillion. The global gold supply is about 35,000 metric tons, give or take. So you just do the math. What is the price per ounce if you have, pardon me, if you have $30 trillion of money and 35,000 metric tons of gold? So you have to make one other assumption, which is what ratio of gold to money do you want? Well, the answer, 40% historically has been enough. The Austrians say it's got to be 100% or nothing. That's not true. A 40% backing is pretty strong. That'll work. So if you have $30 trillion of M1, 40% of that is 12 trillion. If you need $12 trillion worth of gold and you have 35,000 metric tons, what's the price? Well, it comes out around $15,000 an ounce. So again, that's not some number I pulled out of the air just to attract attention. I mean, I don't need that, and I wouldn't work that way anyway. It's a very straightforward math problem, but that is the implied non-deflationary price of gold. That is the price that gold would have to be to avoid inflation or deflation on the gold standard. So that's one method. There's another method, completely different, which interestingly ends up in the same place, which is it's more of a technical method. So we've had two great bull markets in gold, starting in 1971. Prior to 1971, you didn't have bull or bear markets in gold because we were on a gold standard. It was a fixed price. It didn't go up or down. It was fixed. Yeah, there were adjustments during the Great Depression. The dollar was devalued, but then prior to the 1870s, gold was money. People walked around with 8-gram coins. The British sovereign was the classic, but go all the way back to the Roman Empire earlier. There was no question of exchange rates. Gold was money. But beginning with say the 20th century, we've had these various gold standards. They weren't broken completely until 1971. So that's the where you begin your analysis of bull and bear markets. So the first great bull market was 1971 to 1980. Gold went from $35 an ounce to $800 an ounce. That's about a 2,000% increase. Then you had a long bear market from 1980 to 1999, slow, gradual, but just kind of ground its way down. Then beginning in 1999, when gold was $250 an ounce, you had the second great bull market, which lasted for 12 years, from 1999 to 2011, and gold went up almost 700% from $250 an ounce to $1,900 an ounce. And then you had another bear market from 2011 to 2015. The third great bull market started, we know the exact date, December 16th, 2015. It's when Janet Yellen's liftoff took place, ironically, and gold was $1,050 an ounce. Today, it's up over 80%. As you mentioned, it's $1,800, $30 or $40 an ounce. It bounces around a little bit. So in this new bull market, gold is up 80% in the last about 4.5 years. But if you look at the two prior bull markets, one was up 2,000%. The other one was up 700%. So if you just took a simple average of the two, you don't have to get crazy and pick a high number, just a simple average of the two, that would suggest that on average, this new bull market should take gold up about 1,300%, 1,300%. Well, starting with $1,000 an ounce base, that would get it to $13,000 an ounce. So what's interesting is that if you use the implied non-deflationary price in a potential gold standard, or if you simply take a technical analysis using the two prior bull markets, you come out, somewhere around, close to $15,000 an ounce either way. The third thing I would mention, Greg, and this is the part that people just don't understand. Let's say gold's, let's just say $2,000 an ounce. It's not there. It's 1,830 or so, but just take $2,000 an ounce for a round number. And gold was there last summer. Well, to go from $2,000 an ounce to $3,000 an ounce, that's a 50% increase. That's a big lift. You really got to go up a lot. But to go from $14,000 an ounce to $15,000 an ounce, that's only a 7% increase. In other words, it's the same $1,000. If you have an ounce of gold, you made $1,000 either way, and good for you. It's the same $1,000. It's real money, but the percentage increase gets smaller as the absolute value gets larger. So yeah, 2,000 to 3,000 is a long haul. 3,000 to 4,000 is a long haul. That's a 33% increase. But by the time you get to 10,000, it's only a 10% increase to get to 11. Then it's only a 9% increase to get to 12. And 14 to 15 is only a 7% increase. That's almost like 1 week's volatility. In other words, at the end, you start bang, 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 $1,000 an ounce in less than a month, or maybe even just a couple of weeks. So it starts out slowly, but happens very quickly at the end. So whether you're looking at central bank monetary policy, historical bull markets, or simple math, you get to $15,000 very easily.
So, Jim, if I can be correct, you're saying that it will get to 15,000, but you're saying this could be 15 or 20 years away.
No, 5 years or less.
5 years or less?
Yes.
Okay, so in the next 5 years, you think or you feel it will go to 15,000 US?
Yes, I would say 2025. So that's even maybe 4 years.
Okay, all right.
But the point being, it'll happen very quickly at the end. It's not a uniform thing. It'll start to go up $1,000 an ounce every couple of weeks toward the end. So you want to get in now so you can participate in that.
Jim, I have another question here. We had Robert Kiyosaki as a guest, and Robert said on this program, somebody is saying that on the GoCo event 12 months ago, that bank shares will drop. Now, since he said that, some of the leading bank shares in Australia has doubled. Who can we believe? This is the question.
Robert Kiyosaki is a good friend and a very strong economic analysis. So I lean his direction. But I'll tell you why specifically. Greg, it's really important to sort out, because I make forecasts all the time, and I'll make a forecast, and the next day, the opposite will happen, and somebody go, "Well, you're a dope. You did wrong." No, you have to look at short-term, intermediate-term, long-term forecasts. I just gave you a goal forecast, but I specified 4 to 5 years. Most of my forecasts are 6 months, but they're constantly updated. So, but here's the threat to bank shares, not just banks, but also Mastercard and Visa. They could be completely disintermediated and driven out of business by central bank digital currencies. I mean, what's being envisioned right now is, and the Fed is a little behind the curve. China's got a prototype. They're going to really promote it during the Winter Olympics next year. Europe is working on it. The Fed's working on it. They'll probably have something in the next 2 years, but it will get to the point where you'll have an account at the Fed and your dollars will be on a smart card or your smartphone. And when you want to pay somebody else, it'll go right through the Fed ledger. You don't need a bank. Why do you need deposit slips and online banking, withdrawals, and all, balance? Why do you need all that? You don't need any of that. Why do you need Mastercard and Visa? You can just have a digital dollar account at the Fed. So that is that would take bank shares to zero. Again, that's not going to happen overnight, but that's coming. And investors are usually the last to know. Stock market's supposed to be forward looking. They don't do a very good job, but they look forward, but they usually get it wrong. So here's a case where if you don't understand that central bank digital currencies can disintermediate the entire banking system, that's important that you do grasp that, because that would be fatal for bank shares, Mastercard and Visa.
Well, this is a big comment you're making. I love it. This is breaking news. You're saying that the central bank could lead us to Visa, Mastercard. We won't have one anymore. Gone.
Right, because Visa merchant acquirers charge about 2.5%.
Yeah.
Your bank charges you something, may not be a lot, but there are a lot of fees. It's slow, it's clunky, but we have to have it today because we need to pay for things. But if you have central bank digital currencies, and by the way, those are not cryptocurrencies. Central bank digital currencies are not cryptocurrencies. It's still going to be an Aussie dollar or US dollar or Japanese yen. It's just going to be in digital form. The message traffic is encrypted, but the ledger is run by the central bank. So who needs a bank?
All right, this is big. All right, thank you, Jim. We're going to talk more about that, and when I get you back again, this for sure. Look, somebody is saying here, Jim, Harry Dent is saying that China will lead the bust, will lead the way to the next crash. Do you believe that?
The world economy, look, there are all different countries, all different political systems, all different economies. I understand all that. I spend virtually all my waking hours studying it, and I probably dream about it a little bit too. But the point is, so nothing is unlinked from everything else. But China is heading for a fall. I do agree with that. I just explained in my main presentation why U.S. stocks are in a bubble. And so when you're in a bubble, you say, well, okay, what's going to burst the bubble? What's going to change the narrative? What's going to change how people value stocks? Well, it can change internally just because the facts contradict the narrative, and at some point it becomes impossible to ignore. But there can also be an exogenous shock. So could you have a shock where a crash in China leads to a crash in the United States? Yes, that's very possible. And China they have not successfully generated a consumer economy. They're dependent on exports. Export markets are moving away. To me, the future is in places like Vietnam and India. They're going to be the main beneficiaries of the slowdown in China. U.S. is very rapidly moving its supply chain out of China as fast as we can. You know, Americans like to talk endlessly about the difference between Donald Trump and Joe Biden. Okay, there are some differences, but there's one big area where there are no differences. The Biden administration is continuing the China policies of the Trump administration. Biden has not relieved those tariffs. They have not eased up on Chinese investment in the United States. They have not eased up on Chinese students coming to the United States. China it's officially, it's atheistic. They have slavery, genocide, atheism, communism. It's like a trifecta. They support their economy with investment, over half of which is wasted, and they do that with debt, and it's utterly corrupt. So nothing's going to happen in the next 30 days because they got to get this anniversary, or 60 days rather. They got to get this anniversary party over for the 100th anniversary of the foundation of the Communist Party of China. But after that, later this year into next year, at a minimum, you'll see a Chinese slowdown. I think that's already baked in the pie. But the question is, does a Chinese slowdown lead to a Chinese crash? And the answer is it might. And if it does, a U.S. crash could be right behind it because the U.S. stock market is equally vulnerable because it's in a bubble.
Look, Australia continues to have a love affair with with real estate. And the question that's come through here is Australian real estate continues to boom. How long will this go on, Jim?
I would say two things. You have to distinguish between residential real estate and commercial real estate. Often they're linked. Often residential and commercial go up together and go down together because it's driven by interest rates, cap rates, business cycles, liquidity, and a lot of other factors. That's not true today. You have a disjunction where residential real estate is booming, commercial real estate is suffering. So you can't just say real estate, you have to say housing or buildings. And buildings are have not hit bottom yet. That's too soon. But residential real estate, absolutely red hot. Well, the answer is when, and you've got a very favorable outlook. Low interest rates are going to continue to be low. People are moving out of cities into suburbs and into rural areas. We see the same thing in the United States, by the way. I mean, I'm out here in the country. I'm up in the mountains. Try finding a carpenter, a plumber, a painter. You can't, even in the cities, which are getting some in-migration from places like New York. You want to renovate an apartment, let's say. The contractors will say, call me next year, or I'll put you on the waiting list for the end of, we're talking 2022. So yeah, it's booming here too. We see it all around us. But there are two risks. One is, do stock markets crash, and does that cause a liquidity crisis? So all of a sudden, real estate crashes along with it because people are losing their jobs, and or they're over leveraged, and that would contribute to that. But the other one is, does the economy just slow down? Or another scenario, it could be any one of these, by the way. You don't really have to forecast, you just have to list them and say, use the Bernoulli process. So I don't know which one's going to happen, but what are the odds that one of them happens? Well, that can be a lot higher than the odds of the individual things happening, because you got 3 or 4 of them on the list. But the other one's inflation. I'm not forecasting inflation in the short run. I expect disinflation and maybe even some deflation for the remainder of 2021 into 2022. But beyond that, when you get to late 2022 and 2023, yes, inflation could emerge, in which case interest rates are going up, in which case real estate's going down.
Jim, over the weekend, I grabbed this, I ripped a newspaper article out, and I knew I was going to be talking to you, so I'm just going to take a question from it. This is coming from me in the newspaper here. The investment legend Michael Burry, I think that his name. Do you know who Michael Burry is?
Yeah, he was the guy who shorted the real estate market ahead of the mortgage crisis in 2007. He was featured in that movie. I forget the name.
The Big Short.
Yeah, The Big Short.
That's right. He was the guy that they used his profile on the Big Short, and of course, it was a massive win. Now he has come out with 3 new predictions, and it's written in this article over the weekend in the Barefoot Investor, who you won't know who he is, but he's well known here in Australia. Mm-hmm. And the first thing that he said is that and this has already happened at this point, I guess. He shorted himself on Tesla when it rocketed up to by 743%.
Right.
I don't know if he's still short on Tesla, but that's number one. His second prediction was saying he believes that Bitcoin is in a spectacular bubble, and I don't know if that was said before it dropped by 50% just in the last week. So that we've got to take that into account.
I think it was. He said that before the recent 50%.
Yeah. So I think it's already dropped. And thirdly, and he's saying the experiment of printing money is going to lead to hyperinflation and an economic catastrophe worldwide. What are your thoughts? Now, of course, he's saying hyperinflation. You're not saying that.
Not yet. But again, I would distinguish between 2024 and 2021. But let's just take those numbers. First of all, he's 2 for 2. I mean, Tesla did drop and Bitcoin did burst. Now, it doesn't mean Bitcoin won't come back. It probably will. And Tesla's in a world of its own. It's Elon Musk is the greatest showman and promoter since P.T. Barnum. But those 2 things were actually related, because Elon Musk came out and he said 2 things. He said, number one, Tesla is buying Bitcoin. It bought, I forget the exact number, but it might have been upwards of $1 billion equivalent of Bitcoin. Number 2, he said that you could buy a Tesla with Bitcoin, that they had made arrangements, and if you wanted to pay for Bitcoin, that was fine. Well, that was, I talked a little bit about, when I was talking about the stock market in my keynote, I was talking about narratives. Well, that narrative dominated the Bitcoin world. I mean, you just look at a Bitcoin price chart, right? And then look at marketplaces where Elon Musk made those statements. It went right up from there. Now, here's the point. What Musk missed is that if you link Tesla to Bitcoin, all of a sudden your stock price doesn't have anything to do with promoting electronic vehicles anymore. It has to do with the price of Bitcoin, because Bitcoin going down was not only going to affect Elon Musk's Bitcoin, it was going to affect the price of his stock. I don't know this for a fact, but my estimate would be that somebody tapped him on the shoulder and said, hey, E, do you realize that you've now linked the price of your stock to Bitcoin? And then it comes out, it was literally just a matter of a few weeks, and says, you know what, time out. We're not taking Bitcoin for Tesla. You can't buy Tesla with Bitcoin. And he said, we're not dumping it, but we're not buying any more. And then the price of Bitcoin started to crash immediately. And of course, that took the price of Tesla down, and Michael Burry made a lot of money. But I think Musk failed to understand that he had a stock that was volatile enough. He was a very good promoter. Every time I see a Tesla driver, in an expensive neighborhood, I see a Tesla, I want to pull the guy over and get my $7,000 back, because we have a $7,000 per vehicle credit in the United States, but I pay taxes to give the other guy $7,000 credit on his Tesla. So I want my money back. But that aside, so he's a great promoter. I'll give him credit. Whenever you can get the government to subsidize your business, it's pretty much of a sure winner. Good for him. But I think inadvertently and mistakenly linked the stock price to Bitcoin. So not only did Barry get it right, but it was a twofer, because when Bitcoin went down, Tesla went down with it, and he made money on both positions. Now, coming to printing money, again, I'll repeat what I said in the keynote. Money printing by itself has nothing to do with inflation. Money printing does not cause inflation. What causes inflation is velocity, the turnover of money. So let's talk about velocity. Velocity is behavioral. It's psychological. It's something the central bank can't control, and it runs on a narrative. And so right now, there are inflationary expectations, but there's not actually any inflation. It's just not showing up in the data. People are saving. Savings rates are sky high. Savings rates, and this is slowing the economy down, because if I make $1, I can spend it or save it, right? Well, the savings rates for 20 years have been averaging between 5 and 8%, with a central tendency around 7%. In the second quarter of 2020, they went up to 33%. Even as late as last summer, the savings rate was over 20%. Then it came down to 13% last November, and I looked at it and said, well, interesting. It went up to 33%, it was chugging up, and then it came down to 13%. Does that mean it's going to drop back down into that central tendency of around 7? No, it actually went back up. It's back up over 20. So these are historically sky-high savings rates in the United States, but that means people are not spending the money. There's very good data that shows, these government handout checks, every American, they got $600 at the end of last year, they got $1,400 the first week of March, and everyone said, this is going to stimulate the economy. No, the data is very clear. The data shows that 75% of the government handouts are either being saved or used to pay down debt, which economically is the same thing. When I pay down debt, that's not new consumption. I'm just paying off the consumption that already happened, last year or the year before. So it's all going into savings and debt reduction, which is a form of deleveraging. So there's no inflation on the horizon. So here's the question from Michael Burry, and here's the question from monetary economics. The money's there. It's like dry wood, but you need a match. The match is velocity, which is a change in psychology. What's going to cause that? Now here, just to tie it all up with a bow, going back to what I said about in the keynote about how Bitcoin will not replace the dollar, but it may destroy the idea of money. And in 1917, French artist Marcel Duchamp was invited to contribute to an art exhibit, and he went to a plumbing supply store and bought a men's urinal, and he signed it, Armat 1917, and he put it in a horizontal position in the gallery. And everyone was shocked. No, you can't do that. That's not a painting. It's not a sculpture. It's not art. And he was saying to the world, no, art is what the artist says it is. He was the most influential artist of the 20th century because he forever changed the definition of art by saying art is what I say it is. Well, maybe money is what I say it is, or money is what anybody says it is. And this is the real danger of Bitcoin. I don't care if the price goes to 100,000 or 10,000. I don't own any. I'm not going to buy any. And as I say, if you want something, knock yourself out. That's irrelevant. That's content. It's like you're missing the bigger picture. The bigger picture is we are immersed in an electronic environment created by Bitcoin, which destroys the notion of money the same way a urinal destroyed the notion of art. And if you do that, you may lose confidence in all forms of money, and then you get the hyperinflation.
Jim, I'm going to ask this question. Of course, you made a quote on our station, on our show, and it was that Bitcoin will disappear and go away forever.
Right. It will.
Still believe?
Yeah. But not for reasons that anyone understands, but I'll explain to the audience why that's true. Again, the list of objections to Bitcoin is a long list. It's harming the environment with CO2 emissions because the electricity needed to generate the mining. It has no use case. You can't spend it. It's not a good store of value. It just has, there's a long list of things that are objections to Bitcoin. They're all irrelevant. I mean, I can recite the list. I helped to research the list, but they're all irrelevant. Talk about the price is irrelevant. Blockchain technology has been around since the 1980s. There's nothing new about that. Encryption of the kind they use has been around since the 1970s. There's nothing new about that. There's a lot less there than meets the eye. But the thing with Bitcoin is that, as I just mentioned, it is an immersive, all-encompassing electronic reality. We're the fish and we're in the water, and we don't know what water is. We don't know what Bitcoin's doing to us. What it's doing to us is changing our idea of money. So that's the threat. But here's why Bitcoin will go away, because something else will come along and replace it. People will just get bored with it.
How long? How long? What's its life expectancy?
Well, you don't know. You don't know exactly, but probably sooner than later. I mean, do we still use the Pony Express? Do we still send? When was the last time you sent a telegram?
It's all over.
Correct. People just get bored with it, or something else will come along and it'll be obsolete.
So what you'll say, that people will still continue to make money. It might race to 100,000. It'll go up and down, and then all of a sudden it's going to hit the brick wall.
It might even be slower than that, but it'll end up being like Beanie Babies.
Okay. No, I get it. I hear what you're saying. So you're not giving a time frame. It could be a while, but it's going to eventually stop.
Probably not that long. The only reason I say that, Greg, is because technological innovation is coming so fast right now. I mean, it's an obvious statement, but it's true that it was a long time between the 40 years between the telegraph and the telephone, and another 60 years between the telephone and television, et cetera. But things are coming, much faster these days. So it'll probably just be obsolete.
Okay. Jim, last question. And you had been saying that we're heading for the Great Depression. We are going to get hit.
I say we're in it.
You're saying we're in it.
Correct.
We're not quite feeling that in Australia at the moment.
That's true. But you're intricately linked to the Chinese economy and the U.S. economy for reasons I explained in the keynote. So even though Australia does quite well, it is the lucky country. I said, I've been there many times, been going to Australia for 40 years, have a lot of friends there. I understand the Australian case, but you're not immune to a crack up in China. You're not immune to a crack up in the United States. They're the two largest economies in the world. Japan has its own problems. And so you'll be affected by that, whether you like it or not.